You're listening to the Financial Source podcast on YouTube.
Welcome back to the Financial Source podcast. Today, we are tackling a really complex and unusual alignment in global markets. We're seeing risk assets not just holding their ground, but actually lifting, even as the geopolitical landscape remains this incredibly volatile mix of conflict and, well, diplomatic breakthroughs.
And what's fascinating is where the market's optimism is coming from. It seems to be driven almost entirely by domestic policy speculation.
Right.
Specifically, some surprisingly soft macro data out of the United States, which has just aggressively fueled all this speculation about Federal Reserve rate cuts.
So you have this policy impulse clashing with some really high-stakes political tension, especially as we see central banks around the world start to diverge.
Exactly.
The Bank of Japan is hinting at a major shift, while the Reserve Bank of New Zealand just made a definitive move, but also managed its future outlook with remarkable clarity.
We'll be connecting these threads for you, showing how foreign exchange markets are absorbing softer producer prices and, renewed U.S.-China trade talks.
And we'll analyze why key commodities like copper are rebounding despite all this friction we're seeing globally.
You'll learn how to read this disconnect, the talk of a peace plan for Ukraine versus the reality of missile strikes in Kyiv, and really understand the forces steering global risk this week.
Let's unpack it.
Okay, so let's start where that macro signal is the clearest in the United States.
Right, the dollar. It saw a sudden, pretty sharp weakening.
It did. It really suggests the market has made up its mind about the Federal Reserve.
Even if the Fed hasn't made up its own mind yet.
Exactly. So what data points really cemented this dovish view?
Well, it was a string of them, wasn't it? A few key disappointments. We saw soft retail sales numbers.
Right, which suggests the consumer might finally be pulling back.
And lower consumer confidence. But the big one, I think, was the weaker core producer prices, the PPI.
That PPI figure is so critical right now for how the Federal Reserve is thinking.
Why that one in particular?
Well, PPI measures the prices producers get for their goods. So when the core number, which, strips out the volatile food and energy, when that comes in weaker, it's a very strong signal that the inflationary pressure moving through the supply chain is finally fading. It takes the heat off future consumer prices, the CPI, the PCE, which is what the Federal Reserve actually targets.
So it basically gives them cover.
It gives them cover, exactly. Cover to consider a less aggressive stance, maybe even a pivot heading into their December meeting.
And it wasn't just the official data. I mean, the narrative got a huge boost from some incredibly fleeting but market-moving rumors.
Oh, absolutely.
I'm thinking specifically about that brief speculation around Kevin Hassett.
That was a textbook study in just how fragile and eager the market is right now.
For a dovish signal.
For any dovish signal. Reports emerged, even if they were refuted almost immediately, that Hassett was a frontrunner for the Federal Reserve chair. The mere suggestion of a leadership change to someone seen as extremely dovish.
It was enough.
It was enough to fuel instant aggressive talk of rate cuts. The dollar dropped right away. It tells you the market will trade violently on a rumor that lasts, a few hours.
It shows the underlying tension.
That's it. That underlying fragility is what drove the most aggressive moves this week.
So if the market is convinced the Federal Reserve is going dovish, what does this soft data and falling dollar mean for the broader market, beyond just foreign exchange?
Well, if we connect the dots, this expectation of easier policy, it drives down yields across all major economies.
Okay.
And when the return on safe assets like government bonds falls, it becomes cheaper in a way to hold non-interest-bearing assets.
Like gold.
Like gold. We've seen really solid flows into gold because of this. It's playing its dual role perfectly right now. It's a hedge against the geopolitical mess, and it's a direct beneficiary of falling global yields and a weaker U.S. dollar.
Now, moving beyond the U.S., I think the real story is this divergence, how other central banks are dealing with their own unique problems.
Yes, and that's causing some sharp volatility in FX, particularly in Asia. The action in the Japanese yen it felt like a seismic event.
After years of the Bank of Japan just standing alone with its ultra-easy policy.
And now that policy looks very, very vulnerable.
What was the trigger? What caused the yen to move so suddenly after being so stable near those, multi-decade lows?
It was a single Reuters source report. It suggested that the Bank of Japan might be preparing markets for a potential interest rate hike as soon as December.
Wow. That is massive.
It's massive. Even a subtle hint of normalization of moving away from negative rates is enough to cause the dollar-yen pair to pull back sharply from its recent highs. The market is pricing in the end of an era.
The takeaway being that inflation might finally be forcing their hand.
It might be, regardless of what's happening with their domestic growth.
Meanwhile, the euro seems to be holding steady. It's holding above a key technical level. Where is that support coming from?
It's really a two-pronged defense. The weaker dollar helps, of course.
Yeah.
But the real structural support is coming from the European Central Bank. Officials are being very vocal, highlighting that they still have this persistent domestic price pressure.
From where?
Mainly from sticky services, inflation, and food costs. Their commentary suggests the European Central Bank is in much less of a hurry to follow the Federal Reserve down that dovish path.
And that's giving the currency a floor.
A pretty solid one, yeah.
And then just across the channel, we're seeing anticipation drive the pound sterling firmer ahead of the UK's autumn budget.
That's right. The anticipation itself is the driver. We've seen some strategic policy leaks that are keeping traders focused.
What kind of leaks?
Details pointing to things that are good for the consumer, like an increase to the minimum wage, maybe some adjustments to the energy VAT. These signals are keeping sterling firm while traders wait for the official confirmation.
Okay, now let's jump across the Pacific, because the Antipodean currencies offer this really fascinating contrast in central bank thinking.
They really do.
The Australian dollar strengthened, but the New Zealand dollar outperformed sharply, which feels totally backwards because the Reserve Bank of New Zealand just cut rates.
And this is, I think, the most critical moment for central bank analysis this week. The Aussie dollar's move was simple.
Right.
It strengthened just on hotter-than-expected domestic inflation data. It suggests the Reserve Bank of Australia is going to stay firm.
But the New Zealand dollar, tell us why it surged after a rate cut. That just defies basic monetary policy logic.
It's all about forward guidance and certainty. So yes, the Reserve Bank of New Zealand cut rates by the expected 25 basis points down to 2.25%.
Okay.
But crucially, they paired that cut with explicit guidance about the future. They said they're maintaining full optionality, meaning they could move again. But their projections?
What did they project?
A pause. A pause in any adjustments that extends all the way through 2026.
So the market loved the stability.
Precisely. The market hates uncertainty more than anything. By acting now with the cut and then projecting long-term stability with the pause, they satisfied the immediate need for stimulus while just removing all that future uncertainty.
Immediate action followed by projected stability.
It was the perfect combination. It met the market's forward view perfectly, and the New Zealand dollar rallied hard.
Which brings us to the geopolitical drivers, because this is the main source of that disconnect in the market right now. You have these profoundly constructive diplomatic headlines pushing risk assets up, and then they're immediately countered by serious military flare-ups.
It's the ultimate push-pull narrative. On the constructive side, we saw a meaningful thaw between the U.S. and China, at least on economic grounds.
The soybeans.
The soybeans.
Yeah.
The biggest signal was China purchasing at least 10 cargoes of U.S. soybeans. That's a clear economic olive branch.
And we also got confirmation of high-level communication. The White House confirmed a productive call between President Trump and President Xi.
Yeah, and they covered trade, the delicate situation in Ukraine, agricultural flows. The important thing is it confirms the high-level channels are open and they're functional. That's inherently risk positive.
But the biggest piece of geopolitical optimism this week has to be the chatter around a Ukraine peace framework.
Absolutely. The market is reacting to several moving parts here. You had President Trump saying his administration was very close to a framework.
And actual diplomatic steps being taken?
Concrete steps. Special Envoy Steve Witkoff is heading to Moscow to meet with President Putin. There are reports Russia is making concessions on the initial 28-point plan. And President Zelensky himself said Ukraine is ready to move forward.
That collective signal is powerful.
It's powerful enough to overcome a lot of the existing friction.
Okay, but now let's introduce that friction, because this is where the caution comes right back in. The military reality on the ground is grim.
It is absolutely grim. The immediate counter-narratives are that Russia may still reject this latest 19-point ceasefire proposal.
Yeah.
And overnight, we saw active conflict. A barrage of Russian missile strikes hit Kyiv,
Targeting energy infrastructure.
specifically energy infrastructure, causing power disruptions, and Ukraine responded with counterstrikes in Russia's Rostov region. The conflict is happening in parallel with the peace talks.
And this tension isn't just in Europe. We're seeing rising military friction in Asia around Taiwan.
Indeed. Taiwan announced a historic $40 billion supplementary defense budget. That kind of spending signals a very clear perception of increased threat.
And China's response?
Sharp. They stated their readiness to crush foreign interference schemes, and you're also seeing Japan push back on Beijing's comments. So while U.S.-China trade relations might be thawing a bit, the security environment in Asia is definitely heating up.
Okay, so if we put all of this together, the soft dollar, the central bank divergence, these clashing geopolitical headlines, how are commodities and equities actually reading the room?
Well, starting with energy and gold, crude oil is trading cautiously. It's at a tight range, and its short-term moves have been driven almost entirely by that peace optimism in Ukraine.
Right. If peace seems likely, the risk premium on oil just evaporates.
It does. And gold, as we said, continues to be underpinned by the weaker U.S. dollar and those falling yields. It's the key defensive asset right now.
But copper is where it gets really interesting, I think.
Yes. Copper extended its sharp rebound this week. It climbed back above $5.10 a pound. And as the classic industrial bellwether, the signal it's sending is pretty important.
And that signal is optimism. Global growth optimism, not recessionary fear.
That's right. Its rebound reflects this confluence of positive sentiment from the Trump shit call, hopes for Chinese stimulus, and just the general risk-on tone driven by dovish central banks. It's basically shrugging off the military headlines to focus on the economic ones.
And finally, equities. The S&P 500 seems to be holding on to a constructive, if cautious, risk-on bias.
It is, overall. But the tech sector faced a very specific and isolated headwind that we should touch on, the pressure on a key stock like NVIDIA.
Why did a corporate pivot from Meta weigh so heavily on the whole NASDAQ?
This is a crucial corporate story. NVIDIA is, the king of AI hardware right now. But the pressure came from reports that Meta, a huge customer, might pivot toward Google's TPU chips instead.
So it's about competition.
It's a sign that the competitive landscape for AI hardware is evolving fast, and that could potentially erode NVIDIA's dominance down the line. It's a specific corporate fear that acted as a headwind for the whole sector, even as the macro picture got a bit brighter.
So to synthesize this incredibly complex week,
the market environment is basically a battle. It's a battle between policy impulse and political risk. You have very strong dovish momentum from the soft U.S. data, but it's fighting against these deeply mixed geopolitical signals. The push for peace versus the reality of conflict. Exactly. The key for investors right now is balancing that policy impulse, which favors risk assets, with the potential for severe headline risk to pop up at any moment.
So what does this all mean for the future playbook? We saw the Reserve Bank of New Zealand not only cut rates, but they committed to maintaining a pause all the way through 2026.
A bold move.
It's a very bold move. So the relevant question for you, the listener, is this. Could this model cutting rates today to provide stimulus while simultaneously removing future uncertainty with explicit long-term guidance, could that become the new global playbook for central banks trying to manage both inflation and growth?
Appreciate you tuning in to analyze these critical market movements with us today.
We hope this analysis helps frame your thinking as global negotiations continue to steer the narrative. Join us again next time on the Financial Source Podcast.